Welcome to Kuwaiti Dinar Analysts, the channel where we break down oil economies, currency strength, and global financial strategy, without hype and without shortcuts. Today's question is one many analysts quietly debate, but rarely explain clearly. What would happen if global oil prices collapse? And more importantly, could the Kuwaiti dinar survive? This isn't speculation. This is an analysis based on economic structure, fiscal history, and long-term policy design. Let's start with why this question even matters. Oil still dominates the global energy system. That's a fact. But the world is undeniably changing. The adoption of electric vehicles is accelerating. Renewable energy is expanding at an incredible rate. And governments all over the world are now seriously planning for a post-oil future. For countries that rely on oil exports, this raises a massive concern. What happens to your national currency when the river of oil revenue starts to dry up? History gives us plenty of examples and warnings. We've seen countries completely collapse under the pressure of oil shocks. Their economies spiral, their currencies become worthless. But then there are others that adapt and endure. Kuwait firmly belongs in that second category. But the real question is, why? What makes it so different? To understand this, we first need to be clear about what an oil price collapse really means. It doesn't mean oil just disappears overnight. What it does mean is drastically lower export revenue for producing nations. This immediately leads to intense budget pressure and shrinks the fiscal space governments have to operate. For many typical oil-dependent economies, this triggers a predictable and devastating chain reaction. They reforced into currency devaluation to make their exports cheaper, which then fuels rampant inflation. They have to cut crucial public subsidies, and they often rack up enormous amounts of debt just to stay afloat. But here's the key. Kuwait does not follow this typical oil state model, and this fundamental difference changes everything. The secret lies in a concept called the fiscal break-even price. Every single oil-producing country has one. It's the minimum price per barrel of oil they need to balance their government budget. Kuwait's break-even price is consistently lower than many of its peers. This is made possible by decades of accumulated savings and flexible surplus reserves. Think about it. Even during past periods of extremely low oil prices, Kuwait has demonstrated a clear pattern. It covers its budget deficits by dipping into its vast reserves, not by printing more money. It has consistently avoided aggressive borrowing from international markets. And most importantly, it has maintained the stability of its currency throughout these shocks. This is the critical point. A country that can fund its deficits without firing up the printing presses has no economic need to devalue its currency. And that brings us to the real powerhouse behind the dinar's strength, the Kuwait Investment Authority, or KIA. This isn't just any fund. It's one of the world's oldest and most respected sovereign wealth funds. Its purpose is elegantly simple: to turn temporary oil wealth into permanent financial income for generations to come. The KIA invests Kuwait's oil revenues globally across a diversified portfolio. We're talking about global equities, government bonds, prime real estate, and critical infrastructure projects. It holds long-term strategic assets all over the world. This means that Kuwait continues to earn substantial income, even when oil prices are in the basement. This is the structural advantage that sets it apart. Most oil exporters spend their oil money as it comes in. Kuwait recycles its oil money into a perpetual stream of global income. It's a completely different mindset and a far more resilient economic model. So how is the dinar itself protected during these shocks? The Kuwaiti dinar isn't allowed to float freely on the open market like the US dollar or the euro. It is managed through a carefully constructed currency basket system. This system is designed to provide two main benefits. First, incredible exchange rate stability, and second, protection from the volatility of any single currency, like the US dollar. This also gives the central bank a powerful tool to control inflation. When an oil shock hits, Kuwait's playbook is completely different from others. It does not print excessive money to plug budget holes. It does not rush to devalue its currency to gain a temporary trade advantage. Instead, it uses its massive reserves strategically to absorb the shock. In Kuwait, currency stability is treated as a piece of critical national infrastructure, not as a speculative chip to be gambled in the market. Let's draw a quick comparison to really drive this point home. Look at other oil economies. Many depend on oil for nearly all of their government revenue. They lack significant sovereign wealth buffers to fall back on. And when a downturn hits, they are forced to borrow heavily at high interest rates. So when oil prices fall, their only option is to devalue their currency, which hurts their own citizens through inflation. Kuwait is different for three main reasons. Its population is relatively small. Its savings are massive on a per capita basis, and its long-term financial planning is deeply institutionalized within the government. This is why oil price crashes tend to hurt Kuwait's annual budget, but they don't threaten the fundamental value of its currency. Now, let's have a balanced view. No currency is invincible, and it would be foolish to suggest otherwise. The dinar does face real, long-term risks. The global decline in oil demand is a slow-moving but undeniable trend. Public spending within Kuwait is rising, and there's always political pressure to relax fiscal discipline, especially when times are good. But notice that these are slow-moving risks, not the kind of sudden shock that causes a currency to collapse overnight. The dinar would only face genuine, severe pressure if Kuwait's reserves were grossly mismanaged, if government spending permanently outstripped all sources of income, or if the decades-long policy discipline completely fell apart. So far, Kuwait has successfully avoided these critical mistakes. So, let's come back to our final question. Can the Kuwaiti dinar survive a global oil price collapse? The answer is yes, because it was specifically designed to. This isn't about luck. It's not even purely about oil. It's the result of a deliberate, multi-generational strategy built on three pillars: long-term saving, controlled government spending, and a conservative monetary policy. Oil built Kuwait's initial wealth, but it is financial discipline that protects the dinar. If oil prices were to fall off a cliff tomorrow, Kuwait would adjust its budget. It would not destroy its currency. And that is the fundamental difference between a strategy for short-term survival and a blueprint for long-term economic resilience. If you value deep financial explanations like this, make sure to subscribe to Kuwaiti Dinar Analysts. Strong currencies are never accidents. They are engineered. Thanks for watching.